There is a massive anomaly in the market data right now, and almost no one is talking about it. We are staring at $310 billion sitting in stablecoins, yet the total value locked across all of decentralized finance is only $93 billion. Let that sink in for a moment. There is more cash sitting on the sidelines waiting than is actually deployed in the entire yield-generating ecosystem. Retail investors are looking at price charts and trying to guess the next breakout. Institutional capital is looking at this exact liquidity overhang and quietly positioning itself in protocols that generate real, verifiable cash flow. Today, I'm going to show you exactly where that capital is preparing to flow. We are going to strip away the social media noise and look at the raw, hard data from across the on-chain environment. I'll show you the exact metrics revealing a massive divergence between the networks holding the most capital and the networks actually getting used. If you want to understand where the market is going, you have to follow the yield. We need to establish exactly why this specific data matters right now. The market has completely changed over the last 2 years. We are no longer in an environment where a white paper and a promise can command a billion-dollar valuation. The institutions that survived the previous cycles and the new capital entering the space today mandate strict risk management and verifiable revenue. They demand high-throughput execution, ironclad decentralization, and protocols that actually earn more than they spend. This brings us to a critical realization regarding market structure. Most participants simply look at price action, but price is a lagging indicator of network adoption and developer migration. By the time a token price reflects its underlying fundamentals, the asymmetrical trade opportunity is already gone. My goal is to capture risk-adjusted returns before the herd arrives. To do that, we rely entirely on objective on-chain metrics. We track the developers, we track the transaction velocity, and most importantly, we track the earnings. When you align these three pillars, the optimal areas for capital deployment become blindingly obvious. I'll show you why this matters in the data, starting with the foundational layer of all crypto liquidity. Let us look directly at the liquidity base. When we examine the top projects by total value locked, the dominance of stablecoin issuers is absolute. Tether controls $187 billion, and Circle holds $76 billion. This represents the absolute base layer of purchasing power. But where is that money actually going when it seeks yield? It goes straight to the credit facilities. Aave currently holds $41.8 billion in locked value, completely dominating the decentralized lending market. Lido Finance follows with $18 billion. This tells me that smart money is highly risk-averse right now. They are not chasing obscure microcap yield farms. They are parking tens of billions of dollars in battle-tested blue-chip infrastructure. They are establishing their baseline positions before looking further out on the risk curve. You have to understand that capital flows from the safest assets down to the riskiest. Right now, the dam is holding at the safest level. But holding capital is very different from generating real profit. This is where the analysis gets highly contrarian. If you want to see who is actually running a profitable business, you look at the 365-day earnings sum. PancakeSwap is leading the entire sector with $300 million in absolute earnings. Aave is generating $82 million, and the base network is clearing $58 million. This is net value retained after token incentives and operating expenses. PancakeSwap is quietly printing cash. This fundamentally alters how I view risk. A protocol generating $300 million in real yield provides a massive margin of safety compared to a speculative Layer 1 network operating at a loss. When traditional finance evaluates these assets, they are running discounted cash flow models on these exact numbers. Now we have to look at where the actual trading volume is occurring to sustain those earnings. Uniswap executed $14.8 billion in spot volume. They remain the undisputed king of liquidity routing. No one is even close to challenging their dominance on the Ethereum ecosystem. PancakeSwap captured $3.9 billion. But look closely at Aerodrome Finance, capturing $1.9 billion. Aerodrome is aggressively taking market share on the base network. When I see a decentralized exchange capturing nearly $2 billion in weekly volume on an emerging Layer 2, that is a clear signal of retail user migration.
Liquidity follows volume, and volume follows low fees, which brings us to the infrastructure required to support this activity. This migration leads us directly into the great divide between network performance and network usage. If you are building a high-frequency trading application or an on-chain order book, you cannot use a slow network. Solana currently proves its operational dominance with a real-time throughput of 1,140 transactions per second, operating on a block time of 0.39 seconds. Its theoretical maximum is 65,000 transactions per second. The Internet Computer Protocol closely follows at 1,106 transactions per second. Compare that to the base network, which is only pushing 108 transactions per second. Solana is structurally designed for capital velocity. It was built from the ground up to process massive amounts of data without clogging the network or spiking user fees to unreasonable levels. But speed is completely useless without builders. When we look at developer Mindshare, Solana has a massive total base of 10,000 developers. However, when we measure the specific intensity of recent code commits, the Polkadot ecosystem is quietly leading this metric with over 684,000 commits. Ethereum remains deeply entrenched with 8,800 developers. And developer retention is the ultimate leading indicator. Code commits today equal user applications tomorrow. We also have to factor in the systemic risk of centralization. Institutions will not park treasury funds on a network that can be halted by a handful of validators. The Nakamoto coefficient measures this exact threshold. The Polkadot ecosystem has the highest coefficient across all tracked blockchains at 178, supported by 600 validators. The Ton network shows a coefficient of 79. High decentralization metrics heavily mitigate regulatory risk. If I'm deploying capital for a multi-year time horizon, I require networks that cannot be easily compromised or subpoenaed out of existence. So, we have speed, we have developers, and we have decentralization. But who actually has the users? This is where the narrative completely breaks down. Ethereum has the prestige, but the BNB Chain has the masses. BNB Chain commands 53 million monthly active users. Solana follows closely with 43 million. The Near protocol is right behind them at 41 million. Ethereum only registers 13 million monthly active users. Furthermore, when we look at unique token holders, BNB Chain sits at 307 million addresses, and Ethereum has 296 million. Tron has 169 million, and Solana has 162 million. Why is there such a massive discrepancy? It comes down to transaction fees and the types of capital deployed. Ethereum has become a wholesale settlement layer for institutions. Retail users, who generate the daily transaction counts, have entirely migrated to BNB, Solana, and Near. We can prove this institutional preference by looking at where the heavy capital is securing the networks. Ethereum dominates the staking market cap with an astonishing $71 billion securing the network. Solana holds second place with $35 billion, and BNB Chain sits at $15 billion. This proves my thesis. Ethereum is the digital bond market. It's where $70 billion of institutional capital feels safe earning a conservative yield. Solana is quickly bridging the gap, showing that major funds now trust its consensus mechanism enough to lock up $35 billion. When you synthesize all of these data points, a very specific market structure emerges. The data is firmly bullish, but it is highly selective. Capital is not flowing everywhere. It's flowing into Aave for secure lending. It's flowing into Uniswap and PancakeSwap for yield generation. Retail users are utilizing Solana and BNB Chain for cheap, fast transactions. Institutional money is staking Ethereum for absolute economic security. The macro thesis is clear. The market is severely underpricing cash flow generating protocols while simultaneously heavily capitalizing high throughput infrastructure.
My personal strategy right now focuses on this exact divergence. I'm actively managing risk by anchoring my portfolio in the protocols that demonstrate absolute dominance in real earnings and developer retention, rather than betting on speculative block space. If a network is not generating revenue or capturing active users, it does not belong in a serious portfolio. If you value this kind of hard, data-driven analysis over the usual social media noise, hit the like button and subscribe to the channel. I highly recommend you join my free Telegram group for faster daily market updates and real-time on-chain alerts. The link is right down in the pinned comment. Also, if you want to understand exactly how to capture the trading volume we discussed today, watch my step-by-step video on how to earn high yields with stablecoin liquidity pools on Uniswap, which I uploaded just a few days ago. Remember, I am an analyst sharing my research, but this is not financial advice. Thanks for watching, protect your capital, and I'll see you soon in the next analysis.